Welcome back to Insights Now. I'm Gabriela Santos, Chief Market Strategist for the Americas here at JP Morgan Asset Management. As has become tradition for Insights Now, for our final episode of the season, we'll reflect on some of the most important takeaways from the previous 5 episodes that we've recorded. This 14th season was all about the research backing our portfolio managers' investment decisions. And we sat down with a bunch of best-in-class buy-side fixed income research analysts from across JP Morgan Asset Management. We explored a range of bond sectors, including rates, emerging market debt, municipals, high yield, and securitized debt. Today, I'm thrilled to be joined by David Kelly, Chief Global Strategist, as we review the most memorable parts of the wide-ranging conversations we had this season. I'll also ask David for his take on some of the topics we covered, including where rates are headed next, where we seem to have settled with policy change under the new administration, and how he sees the health of the consumer. If you're listening to the audio version of this podcast, you can now watch along on YouTube by tuning into our JP Morgan Asset Management channel, linked in the show notes. Now let's get started. David, welcome back to Insights Now.
Very, very glad to be here. And I suppose let me start off, because you had the privilege of sitting down with these research analysts in the fixed income space. And I guess the first question I would ask you, having talked to them with that sort of as a backdrop, why do you think it is so important that we do have research analysts in the fixed income markets?
I think it's actually even more important than what's already important within the equity space, because if you think about it, the way that indices are constructed in fixed income, it's just based on where there's more debt. That's not necessarily the best investment. So naturally there, I think there's a lot of room for active management. On the research analyst specific side, it's absolutely mind-blowing that there are so many different types of issuers across fixed income and so many different types of individual securities. In one of our episodes with Nini Jenkins from the municipal research space, she highlighted that there are 50,000 different muni issuers and 1 million individual CUSIPs or individual bonds. How in the world is someone supposed to keep track of that unless they're dedicated research analysts? And then lastly, I think you just need a lot of resources as well, because there's so many different sectors within fixed income. And a lot of them actually are barely covered in indices. Things like asset-backed securities, huge opportunity, only 10% representation in the ag, 10% of the universe. Municipal bonds, even within its own index, only 40% of those actual bonds are represented. So it was really an aha moment for me that within fixed income, there's so much to do, and research analysts are extra important.
I think, I hadn't really thought about it, but it is a very interesting point that within equity markets, the most successful companies are those presumably with the biggest equity valuations, and they dominate the indices.
Yeah.
But in fixed income, it's whoever owes the most is the most important.
Not necessarily what you should have as the biggest.
So something to think about. Obviously, a very, very wide-ranging and heterogeneous sort of market, this fixed income market. But I suppose something all of these analysts would have had in common in the first half of this year is just looking at policy issues. So how much did different policies coming out of Washington crop up in your conversations?
It really cropped up across the board. I think if you just think fixed income in general, you have continued to see higher volatility in fixed income and interest rates. For example, short end of the curve driven more about uncertainty around the next rate cut from the Federal Reserve, and then the long end reacting more to fiscal policy and the rise in deficits and debt, as well as trade policy and any potential increase in inflation. You've also had volatility if you look at your more spread-focused parts of fixed income, so more risk. You have seen some volatility in credit spreads. So high yield credit spreads blew out in April and then have come all the way back down, similar to what we saw within equities. And then within different subsectors of the fixed income market, it was really interesting to see how policy is showing up. For example, within municipal bonds, it's really showing up in the bonds of higher education. Think about all the changes that have been floated around federal research grants, international students. That has caused a lot of issuance of higher education to help shore up their investments. Or if we think about high yields, there's a lot of healthcare companies in there. So companies that are exposed to cuts in Medicaid, for example, have been seeing more stress. So it just shows that extra importance of research analysts and differentiation.
And I suppose all of your guests would have said that there are at least some opportunities in their space.
Absolutely.
But having weighed what they all said, where do you now see the biggest opportunities in fixed income?
I was thinking about if there were 4 awards, the most overlooked market that's coming back, that would go to emerging market debt. Kind of how we've seen in equity is international fixed income has been doing better than U.S. fixed income. And that includes emerging market debt. For example, in dollar terms, you have about 7% return from emerging market debt sovereigns. For local currency issued bonds, about 11%. So more than what we've seen so far in the low single digits with the U.S. aggregate. If we had another award, which is where's there actually value and cheapness, which is hard to find anywhere, that would be municipals, exactly because you've had more issuance, more direct policy impact. There you've actually seen negative returns year to date by about 70 basis points. As yields have moved higher, the curve has gotten even steeper. So that's actually something that's looking cheap and interesting. For the award for most differentiation, I would say securitized debt. Still some concerns around commercial, office, versus within the consumer, still some interesting things to do in higher rated parts of asset-backed loans. And then lastly, the most interesting all-in yield would go to high yield still. Spreads are tight, but they're settling in at lower rates, and the all-in yield of 7% is still quite interesting, no matter what the current valuation is telling us. Speaking of bonds, of course, the path of monetary policy always comes up just for overall yield movements. What are your latest thoughts on where the Federal Reserve is likely to go from here?
Well, I think the Federal Reserve is going to take it pretty slowly because I think there's obviously a lot of controversy. They're getting a lot of advice from the other side of Washington as to what they should be doing. But their job is to ignore advice, good or bad, and just do the analysis themselves. And I think that the key thing is, and Jerome Powell has said this in a number of press conferences, they've got 2 goals. One is full employment, which they say is about a 4.2% unemployment rate. That's in their forecasts. And then 2% inflation is measured by the consumption deflator. And if they are missing those targets, they're going to set policy by how much they're missing those targets. Now, actually, we're pretty close to those numbers on both inflation and unemployment right now. But in the months ahead, we think that the unemployment rate will probably rise a little. And we also think the consumption deflation inflation will probably rise by more because you're going to have all these tariff effects feed through. You're going to have fiscal stimulus in early 2026. So by the end of this year, we think we're looking at a consumption deflation inflation rate of about 3%, which is 1 full percentage point above the Fed's target. We think we're looking at an unemployment rate maybe of 4.5%, which is only 0.3% above the Fed's target. So if you look at that, if anything, the Fed should be tightening. Now, I don't think they're brave enough to be tightening, given the advice they're getting from the other side of Washington. But I think that means they're going to take it slowly. And I think there'll be some dissent on the Fed about this. But I think the majority of the voting members of the Federal Open Market Committee are going to look at the economic numbers and conclude that the U.S. economy, while it's certainly showing slow growth, it's not showing signs of imminent recession. Inflation is going up. Maybe inflation will come down. We think it probably will once you get past tariffs and immediate fiscal stimulus. But we don't really know that yet. And we could always, if we could always get another dollop of fiscal stimulus before the next election. We don't know. So from the Fed's perspective, I think they will gradually cut rates, but it'll be very gradual. So I'd be surprised if we saw more than 2 rate cuts this year. I wouldn't be surprised if we only got 1 in December. And then similarly, I think they'll take it slowly the first half of next year. And then if there's no more fiscal stimulus, if the tariff story has just settled in, then I think the inflation rate will gradually come down. And as it's beginning to approach 2% again, then I think the Fed might be able to cut a little bit more. But I would say one other thing. In the 50 years before the financial crisis, the federal funds rate averaged about 1.8 percentage points above core CPI inflation. Core CPI inflation today is 2.9%. You add those two things together, that suggests that a normal federal funds rate is about 4.7%. Well, we're between 4.25%, 4.5%. So rates aren't high. They're just high relative to the emergency rates that we saw after the pandemic and after the great financial crisis. And I think we need a reset here. I think the Fed, it's a fairly normal-looking economy. I think the Fed will want to hold with fairly normal interest rates going forward.
And the economy has been doing fine without emergency rate cuts, like the previous years.
Yeah, and I don't think emergency rate cuts would really help. And the problem is, of course, if you cut rates aggressively, you don't really help economic growth, but you do help asset prices. Yeah. But asset prices do not need any more help. I mean, we've got pretty frothy home prices and pretty frothy stock prices. So I think that it's very hard to make the argument that the Fed should be cutting rates aggressively.
Speaking of the other side of D.C., in terms of other aspects of federal policy, do you think we kind of understand where we've settled and where are the main contours here about policy?
I can't remember ever seeing a news headline which said uncertainty falls.
Yeah.
I mean, uncertainty is always supposed to be rising, but it's never supposed to. But it actually is falling. I mean, if you think about where we were a few months ago, we didn't know the contours of the OBBA, as it came to be called. Never mind the details. Now it's passed. It's a law. So that's one thing. We know what fiscal stimulus is going to be put in the economy early next year. On tariffs, we had maximum uncertainty on April 2nd when the president announced his so-called reciprocal tariffs. That has calmed down. We do have much higher tariffs than we've seen at any time really for decades. But there's less variations. That's in those numbers, and they're beginning to settle in. So, and of course, we've seen a passage of a big increase to the debt ceiling. $5 trillion increase to the debt ceiling. So, all this is kind of behind us, and so some of this policy uncertainty has gone away. Even when it comes to immigration, we're getting a bit of a more of a sense of just how much the immigration numbers are changing. So I think the level of uncertainty about Washington policy has diminished. I think there's still a big question mark about the 2026 elections. If the Democrats take the House of Representatives back, then I think you will actually have a further downshift in policy uncertainty, because then the president's going to find it much more difficult to do things on his own or do things with the support of Congress. But I would say uncertainty has come down, and that's one of the reasons why I think the stock market's gone up.
Yeah. Maybe we've yet to really see the full impact in the economic data itself, but asset markets pricing things in advance kind of have a bit more clarity now.
Well, that's right. And I mean, I would emphasize it's still a point of very high uncertainty because we haven't seen tariff increases like this in modern history, and nor have we seen as sharp a reversal in immigration policy as we've seen. So it is still an uncertain time. And I think for no other reason that the Federal Reserve should look at that and say, we don't necessarily want to jump here until we get a little bit more clarity. Not necessarily in the policy, because I think, as I said, there is more policy clarity, but the impact of policy, there's still a lot of uncertainty about that. Absolutely.
One last question for you, David. Of course, a big topic that came up was the health of the consumer, especially within the securitized debt space. How do you think the consumer is looking right now? It's tough to do generalities.
Well, yes, exactly. I think that's exactly the point. That I think I would talk about the health of the consumers. Mm-hmm. There are the rich consumers, and there's everybody else. And people have talked in the past about a K-shaped recovery. I definitely think we're at a point where we're in a K-shaped expansion. Asset prices have been going up, stock prices have been going up, home prices are going up. We know that the top 10% of households have about 50% or a little over 50% of pre-tax income. They've got about 75% of the wealth in America. So when wealth goes up, when home prices go up, when stock prices go up, it is overwhelmingly the richest in society who benefit the most from it. And that means that spending on, things like restaurant reservations for high-end restaurants or spending on luxuries, new vehicles, that's doing okay, surprisingly okay, given everything else that's going on. But I think it is testament to just how rich the rich are feeling. But for everybody else, I think higher tariffs definitely affect core goods consumption, which impacts the bottom 90% of the households much more than the top 10%. We will eventually get some fiscal stimulus in 2026, but for the moment, there's an issue. I think the change in student loans, suddenly having to pay back these student loans, that's affecting a lot of younger households, and it's squeezing them. And then of course, as these tariffs feed through, it'll show up as higher prices, and I think that's going to hurt consumers at a lower income level. So it's very much two trends here. One other thing that I think is important is we've got sort of this demographic turnaround also. We don't have as much growth in the number of households, and that affects the demand for broad consumer goods. So I'd say if you look at people worry about credit card debt and overall household debt, I'm not that worried about that in aggregate, because honestly the growth in assets has been bigger than the growth in debt. And the servicing of debt, it's still overwhelmingly, debt is fixed rate mortgages, and those are, mostly in the 3% still. For
the lucky ones.
Yeah, exactly. If you once you have a home, a mortgage in place. So I think that looks okay. I'm not that worried about credit fundamentals, but I am worried about a squeeze from higher inflation on lower income consumers, a squeeze from higher student loan payments, still very high mortgage payments. So there's a lot of toughness for lower middle income households, even as richer households are doing better.
So no collapse in consumption overall, but you certainly feel that in the sentiment.
Well, that's right. And so what I think you're going to see is we're not going to talk about 3% consumption growth or even 2% consumption growth. I think what we're looking at is something in the 1 to 1.5% growth in consumption, which is not that strong by historical relative to history. But I do think that it says that the economy, will probably avoid recession, but this is a slow tortoise of an economy because the great mass of consumers aren't really feeling that healthy.
Thank you so much, David. That's super, super helpful. And thank you for joining us today for Season 14 Wrapped. This episode marks the end of Season 14 of Insights Now, but don't worry, we'll be back shortly. With a rapidly evolving policy, economic, and market backdrop, 2025 should continue to be a very exciting year with plenty to discuss. To all our viewers and listeners, thank you for tuning in today, and we'll speak with you soon.
This material is for information purposes only. The views, opinions, and statements of financial market trends that are based on current market conditions are those of the speaker and may differ from those expressed J.P. Morgan Asset Management or by other areas of J.P. Morgan Chase & Co. Any companies referenced are shown for illustrative purposes only and are not intended as a recommendation. We believe the information provided here is reliable, but should not be assumed to be accurate or complete. The views and strategies described may not be suitable for all investors. This content is intended for information only based on assumptions and current market conditions and are subject to change. No warranty of accuracy is given. This content does not contain sufficient information to support investment decisions. It is not to be construed as research, legal, regulatory, tax, accounting, or investment advice. Investments involve risks. Investors should seek professional advice or make an independent evaluation before investing. The value of investments and the income from them may fluctuate, including loss of capital. Past performance and yield are not indicative of current or future results. Forecasts and estimates may or may not come to pass. J.P. Morgan Asset Management is the asset management business of J.P. Morgan Chase & Company and its affiliates worldwide.